Hello, folks. This is the last in a series of my analysis of the 2009 results of United Bancorp of Michigan, United Bank and Trust. And today I'm going to talk about the fact that the bank needs capital infusion of about $8 million, see what that's going to do to the balance sheet. Uh, going to state that some further analysis is going to be required above and beyond what I've done here. And if you're been following this at all, you know that that's true. And then finally, just going to summarize everything that I've talked about over the last 4 videos. And moving on. Okay, let's talk about the capital analysis. An additional, as the bank mentioned, additional $8 million in capital is needed to shore up its balance sheet, and that was necessitated based on a memorandum of understanding that the bank entered into with the FDIC and the Michigan State Regulatory Commission that regulates banks. The capital on the balance sheet, which includes common stock, preferred stock, and retained earnings, has been declining for the past several years due mostly to loan loss expense. Although it can't be blamed entirely on loan loss expense. Prior to a couple years ago, there wasn't the level of loan loss expense that there is today, but the retained earnings was still going down a little bit. In 2009, United Bank and Trust received a capital infusion from the U.S. Treasury in the form of about $20 million in preferred stock. The capital was supposed to be used ostensibly for, to purchase or to obtain a little bit weaker banks, to kind of help in sort of a consolidation. This was theoretically a U.S. Treasury goal, and that was supposed to be the purpose of it. But what happened is, with so much loan loss, they couldn't do that, and now they need it just to bolster the balance sheet right now. The preferred stock that they did get comes with various restrictions as to the ability to declare dividends to us shareholders. So that's a big problem with that. With that capital, with that preferred stock. And as I mentioned, memorandum of understanding requires 9% capital ratio by mid-June, and that necessitates the $8 million additional stock offering. Now, that stock offering is supposed to be coming somewhere around the middle of June, so we should be hearing something about that pretty soon. And when that comes, at the year end, the balance sheet should look again like one of these 3 columns, based on whether you believe the conservative loan loss for the year or the optimistic loan loss for the year. And what you see with the $8 million, it's the same as the prior balance sheet that you saw in the last video, except that added $8 million here to common stock and added $8 million to one of the probably other investments, because that's where I kind of figure that $8 million is going to go, based on what the trend seems to be in putting any free cash into short-term investments, into additional liquidity. And what this ends up happening, or what this ends up doing, is the capital ratio in the most conservative, the worst loan loss case, is it's going to end up at 9.3%. Remember, the bogey was 9%. The most optimistic situation is that with the loan loss being maybe closer to $11 million, generating a net income of $2.1 million, the capital ratio is going to be about 10%, 10.2% thereabouts, which is kind of close to where the capital ratio was, say mid-decade, when it was crowding 10%. And here's a comparison again of what the balance sheet looked like at the end of 2009, and the capital ratio was 8.9%. Now again, that capital ratio includes, in the 8.9, it includes the preferred stock of $20 million that was that the Treasury input into the bank. And so what I've got here is sort of a showing the trend in the capital. This is including, this up here is including the additional capital, and this below is excluding that additional capital. So at the end of the year, assuming the $19 million in loan loss, or a net loss of $4.3 million, the capital ratio is going to be 9.3. If the $20 million in TARP funds had not come in, the capital ratio would be 7.2%. So that's about 2% of capital is what that TARP money is getting. Now, the further analysis that's needed is basically, given the range of net incomes, where should the stock be valued? You'd have to, or I would have to, compare that to other banks, similar banks, and see where they're valued, and see what United Bank and Trust is, how they're valued compared to those. And right now I just have not had the chance to do that, but that's further analysis that should be done. If I can do it later, maybe I will. Now, just finally take a minute or two to summarize what these last 4 videos have talked about. Basically, the interest income has decreased over time due to a smaller loan portfolio. As you recall, the loan portfolio has gone from like 690 down to $630 million, somewhere thereabouts. And that has caused the interest income to come down, although the total core income has been relatively stable. And again, core income is everything pre-tax except for loan loss expense. Loan loss expense has been the big problem, and my feeling is probably some loans were given in mid-decade when the economy was good, and those turned into problems when the economy tanked. And because of that, the bank had to sell preferred stock to the U.S. Treasury to maintain relatively healthy capital ratios. And again, here's where I disagree. I don't think it was ever intended to be used to pick up other troubled banks, to encourage consolidation. I don't believe that was ever going to happen. In 2010, the bank's core earnings are going to be somewhere around $13 million. Loan loss expense is going to be between $11 and $19 million. So the net of that is going to be somewhere between a loss of about $4 million and a gain of about $2 million. So that $6 million range is what the net income is going to be for the bank. Due to net losses, the bank has to raise the additional $8 million capital by mid-June. We talked about that, and we should be seeing that in the next couple weeks. And when that happens, the bank's year-end capital ratio is going to be between 9 and 10%, but that includes U.S. Treasury capital. And again, there's no intention at this point to get rid of that U.S. Treasury capital. I'd just like to say thanks for attending, all you folks who have who've paid attention to all this. Come visit my blog, tecumsehbank.com. Feel free to opine on anything, and send me a letter, and hopefully I'll continue this and make it educational for everybody. Thank you once again. This is Greg Forstoffel signing off.